So last month, the S&P absolutely crapped its pants, down about 5%, and it doesn't look like it's going to get better anytime soon, with companies like PayPal and Facebook getting absolutely obliterated on their earnings. But one of my portfolios, the eToro Coffee to 100k challenge, actually was green on this month by some divine intervention. So in this video, I'm going to review the portfolio, talk about some of the buys and my strategy going forward, and also how the hell we actually made money when the market was crapping its pants. Am I a genius? Am I just a bloke in a beard? Or was it just complete luck? But as always, before we get into it, if you could do me the kind favor, smash that like button until it turns whatever color your device allows. It greatly helps me out with the YouTube algorithm and helps me push this video to a larger audience. And also as well, if you have not done so already, sign up with eToro on the pinned comment. Use one of them links, even if you're from the States, and you do indeed get lifetime access to our Discord just for using one of them links when you sign up. So look, if you haven't caught up to speed yet, there's a video playlist up there where you can see the full in-depth guide of what we're actually doing here. But simply put, one big Starbucks coffee a day in New York roughly equates to $180 a month. A coffee to 100k. That's the challenge in itself. But thinking on it, with inflation and prices going up, we should raise this $180 too. What do you think on that? Let me know down in the comments. But January was absolutely insane. Most of the portfolio is in one sector, as we'll talk about in this video, and that sector started to bottom out and show signs of recovery, while the S&P itself fell 5% and actually showed a little bit of recovery in the last couple of trading days. At one point, the portfolio was up like 4, 5, 6%, and then it fell down to a negative and then closed the actual month green up 1.2%, which you have to ask, why? Well, I'm going to explain my current thesis in this video and also how I plan on beating the market this year and next year. I think that we're due a decent correction, and I'm hoping that my portfolio doesn't get hit at all. So let's have a little look at the portfolio itself and go through some of the things. Now, I just want to clarify here, everything I invest in here in this portfolio is obviously not my total net worth. My main portfolio is spread over several brokers, and if you want to see that, you can check it out in the long-term investing room. I post it there every single week, the buys and sells I've been doing. This is just simply a challenge to motivate some novice investors to get regularly saving and hopefully over the long period of time beat the S&P 500. But on looking at the portfolio itself, let's just review last year because it's been a while. We actually lost 1.94%, even though we were up quite a lot at the beginning of the year. We did sort of end badly, and that is down to one thing: China. But given the fact that the S&P 500 went to the moon last year and we lost 1.94% is quite disheartening for a new investor. But actually, to me, I lick my lips because this is the type of thing I love. It can be disheartening to a new investor, but this is actually what my strategy is. My strategy is I do not want to follow the crowd. I want to be in the next sector. The way I always sort of phrase it is, let's say the S&P 500 last year, or the tech sector, or the meme sector, or NFTs is a train, and that train's moving fast. You're stood at the platform, you can jump on it, and you might get to your destination a little bit quicker. You might get there, but also because it's moving so fast, it might hit you, you might get crushed underneath the train and never see the light of day again. For me, I like to avoid this train, stand patiently, wait for it to pass, and aboard the next one, and patiently wait for it to leave. What this means is I can grab a coffee, I can take my time and buy more shares. But looking into the portfolio itself, we can see that our biggest holding, as expected, is Alibaba, coming in at about 26.95% at the recording of this video. But Alibaba is due to put out earnings, and bear that in mind that this figure might change up or down. We don't really know until these earnings come out. But a lot of people are asking, is this too much in terms of diversification? Now, I don't want to confirm myself to Mahesh Pabrai or Charlie Munger, although I do have a beard like Pabrai and I'm pretty old like Charlie Munger. But these guys will also tell you that diversification is only relevant to people who don't know what they're doing, and that might sound really confident, but I know my strategy over a long term works. I just know this is going to play out well. And again, sounds like overconfidence, maybe, but if it's not for you, you don't have to copy this portfolio. And if it's your first time watching this, yes, you can actually go and physically copy this, and eToro's algorithm will buy and sell as I do, and every month you can just top it up with your $180. But my whole thinking is that Alibaba is one of the biggest companies in China, and it is also, China, one of the biggest economies in the world, soon to be the biggest in the world at some point. And everybody at this point still complains about China because we do have an overexposure to China itself. In fact, if we look at the statistics, our portfolio is actually 54% invested into China, and we're down 25% on the sector itself, which I think is not that bad if you look at how far Chinese stocks have fell in the last year itself. But I feel that the Chinese regulation concerns are really overblown. I think that Didi was made an example of. The Chinese government wins there, and the other companies being listed in the States is a way for them to raise money without having to debt up to the eyelids the Chinese people, who seem to be already quite debted up. And I also think that the Chinese communist government is not the communism of old Mother Russia that people think, to be honest, because China realized at one point its people are struggling, starving, and not technologically advanced. But now, China is the epicenter of technology, and it's clearly growing at a faster rate than most big economies in the world. Whichever way you paint it, the Chinese economy is much stronger with companies like Tencent, Alibaba, JD, to boost up their infrastructure without the Chinese government having to boost it themselves. So I don't think that they're going to disappear. I don't think they're going to nationalize them. And I think China's gone past that point and made sort of a hybrid communism. It's took sort of Singapore's business model and implemented it into its communist regime. We have to see it as a new regime. I don't think you can compare it to the communism of old. My second largest position is 𝐶QQ, which is an ETF following the Chinese tech. So again, Chinese exposure there, but that is sort of spreading a lot of other companies in China that I don't have access to because I don't bloody read any language other than English. The third biggest holding is Smith & Wesson. We're down about 6% on there. I did a video recently on Smith & Wesson. You can go and check it out up there. I absolutely love this company. I think it's severely undervalued. And although people think guns are dying, Smith & Wesson has sort of changed its business model ever so slightly too. And I think just on its assets alone, this company is trading at a severe discount. The next big one, which I just added to, funnily enough, is Tencent Music and Entertainment. The reason I doubled down on this in full transparency is because it's down way too much, and I hope it stays down further. I'll probably allocate another 10% to this. I think this company got hit one of the hardest when the regulations came out, especially with them regulating the education industry in China. But if you actually look into why they regulated the industry in China in terms of education, it was down to a lot of companies overcharging Chinese people and their kids to actually get education from the Western world. So I think it was a mix of keeping the Chinese culture, but also keeping a regulation on how much people can spend and afford, because they have a very different culture to where I grew up in the UK, where a public school was good enough. The Chinese people really want to push their children to the highest level possible, and they'll pay absolutely anything to get that education, even if it is shit. And the next biggest one is Baidu, again China, but then we have Walgreens, Foot Locker, and JD Witherspoons, which we're all down on, but again, that dictates with the strategy. I like to see my biggest holdings to actually be red so I can size into them, because as soon as I start making 50-60% on a profit and it's my biggest holding, that tells me it's time to start looking at taking some profits. So what's going to happen in the coming year? Well, look, my sort of banging on this channel is coming into fruition. I've been warning of a hype bubble with certain sectors and certain stocks. I've been warning that PayPal, Facebook, some of these companies are severely overvalued, and that's starting to play into fruition, albeit Facebook is actually a company I'm starting to really look at. I think that the overhype that we have in the market and the overpricing in certain companies, EV sector is another example, Bitcoin, crypto is another example, and I think with inflation, people are going to start scrambling to get their cash together and look to buy more tangible assets. I've been banging on about this for a long time now, and I think it's very important that we basically adjust for the next train. I think that we can get crushed. And if you think I'm wrong there, just look at like the examples there of Facebook and PayPal, who've just been literally annihilated if you jumped on that train and thought it was over because they already fell like 10%. No, it can fall a hell of a lot more, and Facebook's the great example there with its earnings coming out a couple of days ago. But my point here is, if you always look to buy good value and you slowly buy that value on the way down, eventually when the stock does recover, provided it will recover, of course, then you're lowering your risk. And that's what I've been doing with these Chinese plays. I think that it's a matter of time before the whole Chinese situation calms down. It could be years, by the way, and in which case I hope it is, so I get more exposure at a lower price, bringing down that average. That's what I want to happen. This portfolio is going to last like 14 years. We need to take the risks at the beginning to get the biggest bang for our buck. So for example, in this portfolio, we put in about 6 grand, and if we lost 5 grand of it, that's like a decent amount of loss. But in percentage terms, if it was at the end, it's going to bloody ruin you. So that's sort of my thoughts and thesis. I think that the next sort of 2-3 quarters is going to be quite up and down for the S&P 500, if not stagnant. I think the Fed rates and everything like that's going to scare the pants off the market, and more people will go into already discounted stocks with big cash flows. Again, Alibaba is a good example there. Provided that the Chinese regulation sort of slows down and stops, I don't see any big problems, but let's see that one for the future. If you've got any questions on positions I hold, you can go and drop them down in the comments. You can also go and see this portfolio if you sign up with eToro via the pinned comment. Drop the code word down below, which is banana. And if you want to see more on eToro and see the whole playlist, you can go and check it out up there. I talk about a bit of my strategy and also how I plan on seeing this portfolio play out from start to finish. That's it from me. Be safe. Good luck with your investing journey. See you in the next one. Peace.